Hello, everyone, and welcome. You're listening to the Staking Insider, where we provide actionable insights from thought leaders of the staking industry to analysts and investors. Today, we're thrilled to have with us Darren Langley, General Manager at Rocket Pool. Rocket Pool is a decentralized Ethereum liquid staking provider and one of the biggest names in the liquid staking industry, along with Lido and Coinbase, with about 800 million worth of US dollars staked in ETH and operating more than 2,200 validator nodes. Rocket Pool started as a project in 2016, had a token sale in 2018, and its protocol mainnet launch on November 9, 2021. Darren has 18 years of software development experience. As a technical lead and architect, he has built cloud-based application architecture and digital projects for governments and financial services. He joined Rocket Pool in May 2021. In this episode, we'll take a deeper look into Rocket Pool and the effects of the Ethereum Shanghai Upgrade, how Rocket Pool differs from other liquid staking solutions, and insights into key liquid staking market developments. Welcome, Darren. Great to have you on the show.
Thank you very much. Thank you for inviting me. It's fun. Actually, I did join Rocket Pool in 2008, but I had a hiatus in the middle. So I joined for about a year or so, and then had that hiatus in the middle, and then came back in 2021.
Okay.
So I was a developer at Rocket Pool, and then I came back as the GM. So yeah, so it's exciting. I was really looking forward to the opportunity.
Like a glorious return. That's a great.
That's right.
Great. So explain to our audience what is the difference between liquid staking and normal staking to start off.
Okay. Yes. Well, actually, so liquid staking kind of solves a problem with normal staking. So Ethereum staking, as it works normally, is that it has kind of some high barriers to entry. So I should start. What is Ethereum staking all about? It's about securing Ethereum. When people do all the fun stuff they do on Ethereum, whether it's like trade NFTs or swap tokens or do crazy aping into DGNE things, all of those transactions are actually formed into blocks by proof of stake validators. And all of those proof of stake validators are actually staking their ETH and securing Ethereum. And, Ethereum has something like 18 million ETH, I think that's staking at the moment. I think that's around like $25 billion or something like that. And all of that is kind of like economic security for Ethereum. So it's kind of how Ethereum kind of works under the hood, and it's secured. So that's Ethereum staking. And it's a big deal because it's what kind of drives Ethereum. But the thing is, it hasn't. For doing that, for staking your ETH and performing this kind of technical service for Ethereum itself. So for running this validator and doing all that work, you're actually rewarded with new Ethereum. So as kind of say, you can pay your costs and all of that sort of stuff. So you're rewarded with this new Ethereum. But there is a high capital to entry. So you need 32 ETH kind of minimum, and you need 32 ETH in like 32 ETH blocks. So for one validator, it's 32 ETH, but if you want two validators, it's 64, all of that sort of stuff. So that's quite of a big barrier to entry. The other one is you need to run a node, run this validator to actually do it, which is getting easier and easier, but it's still something that many people are not kind of comfortable doing. And then until Shanghai is released, it's actually a one-way thing. So you're staking, you're depositing, but you cannot withdraw the moment. That changes when the Shanghai kind of hard fork happens. About that. But so that's Ethereum staking. Liquid staking is essentially people who want to stake their ETH but don't want to actually run a node themselves. What they do is they deposit it with a staking provider. The staking provider then takes that ETH and then stakes it within the Ethereum proof of stake system. They earn the rewards on that, and then they share those rewards with the people who deposited their ETH. There are some significant benefits with liquid staking. Obviously, the first one is that you don't need to run a node. You're just supplying the ETH. You also can supply any amount of ETH. So you don't have to supply 32 ETH or anything. You can supply any. So with Rocket Pool, you can do that from as little as 0.01 ETH, I think it is, all the way up to a silly amount. So that's, so you can do any amount. And then the last benefit of liquid staking is when you deposit your ETH, you get back this kind of liquid staking token, or as kind of like a receipt. In our case, it's RE, which is our liquid staking token. And you can hold that liquid staking token, and it accrues the rewards that the validators are actually doing. So, the most simplest thing you can do is hold that within a hardware wallet, and it'll accumulate those rewards over time. Or you can then take that and use it in DeFi. So, for example, you could open up a CDP in Maker and borrow DAI against it. You could put it into an options platform. You could do all those kind of like fun things, that stuff as well. So sorry, I had to kind of lay everything out there for you, but that's kind of Ethereum staking and liquid staking.
So that's in about 6 minutes, everything explained. That's a very good primer, so to say, for our audience. And this
Very
was
good.
the best time I've seen so far. Somebody really going from 0 to 1 on this. So if we look at Ethereum staking and liquid staking, the market roughly looks, so you can check Dune Analytics, for example, as you mentioned, 17.9 million ETH deposited into staking, and you have the number one entity for Ethereum staking is Lido, has about 31% market share. After that comes Coinbase. Both of them have their liquid staking token. After that comes Kraken. We had the whole SEC crackdown on staking with Kraken there as well, with a $30 million settlement. And then you have Binance, another centralized exchange that's offering staking, Stakefish, Stake US, Figment, which is a plain vanilla staking provider, so to say. And then comes Rocket Pool. In terms of Rocket Pool, with a market share of currently 2.5% of all staked ETH. And if we just look at the liquid staking providers, it is number 3 with about 5.5 or 6% market share of all the liquid staking tokens. This is like the rough market overview for our audience and the field in which we are moving right now. My question to that is, how does Rocket Pool work as a liquid staking protocol compared to the other two liquid staking providers, Lido and Coinbase? What are the main differences?
Yeah, so that's a good question. So taking my description before, so in the kind of very high level description is that when you stake with a liquid staking provider, you deposit ETH, you get this liquid staking token back as a receipt. That ETH is then staked by node operators. Okay. Now, the main difference, there's a couple of differences actually. So that with Coinbase, for example, they are custodial. So they hold the keys to the accounts that hold your ETH. So that's kind of one aspect of it. And you're kind of handing it over to stake that ETH as the node operators. Okay. Essentially kind of one entity to stake the ETH. So that's the thing with Coinbase. With Lido, you stake the ETH and it goes into like a smart contract. So it's not necessarily custodial. It's custodial in the sense that it's within a smart contract, but you don't have to. It's less trust involved in that sense because they're not actually holding your ETH. They're actually in a smart contract, which you can't do anything but stake it. So that's the idea behind that. So it's a bit more trustless, but you're still staking it with a small number of entities. So Lido at the moment, I think, has something like just over 20 node operators. So each one of those node operators is running thousands and thousands of validators. And so you're kind of spreading across 20 node operators. The difference between, and Lido, the reason why it's kind of small is because they have to have a trusted validator set or permission validator set. So they essentially vet who comes into and who can be a operator. They're obviously working on kind of a more permissionless model. We decided to do it from the very beginning. So the difference between us is that anyone can be a node operator with Rocket Pool. But the thing that makes us different is that every one of our node operators brings their own collateral as a node operator. So every validator that gets spinned up is currently 16 ETH of node operator funds and 16 ETH of liquid staker funds. The idea behind that is, first of all, proof of stake is called proof of stake for a reason. There has to be something at stake. The other thing is that if anything goes wrong, so staking is it's relatively low risk. There's very well, so there's very few risks, but there are risks. And so there are things like slashing risk that come into play. So a node operator can get slashed. They could be offline for a certain amount of time, and that's the sort of thing which kind of reduces the amount the rewards you get and all that sort of thing. So slashing means that they take a hit on, they lose, I think it's something like 1.5 or 2. You have to go out of your way to kind of get slashed, but it does happen. And in those cases, you need to have the collateral to cover that. In Rocket Pool's case, no RE liquid stakers get hit. It's all dealt with by the node operator collateral. So essentially, their node operator collateral takes the hit when the node operator doesn't. So that's how kind of Rocket Pool works. Our node operators are economically aligned. There's kind of built-in insurance, essentially. With other staking providers, you have to rely on insurance, which may or may not cover the amount that gets slashed or whatever. But with Rocket Pool, it's all kind of built into the protocol because we've gone for a trustless and permissionless model from day one, which is kind of why it took us so long time to build it.
Mhm. So permissionless means anybody could spun up their validator, but economically they are already incentivized to do it in the best way according to all best practices of running these
Yeah.
nodes.
Yeah,
It's
they have their funds on the line. They have skin in the game. They want to get as much of a return on. They want to earn as many rewards as possible for themselves because they also get a commission on the rewards they generate on behalf of the pool. And so they are economically aligned to do that. They're incentivized to do that.
And Rocket Pool node operators with like 16 ETH requirement, they receive up to 7.26% in rewards per year, while normal stakers receive roughly 4.68%. How does this work? Where does this difference come from? What
Yeah.
constitutes the difference?
So currently node operators receive a commission. So node operators for performing this service, running the validator node and all of that sort of stuff and looking after the ETH, they get paid 15% of the rewards they generate on behalf of liquid stakers. So we're actually reducing that commission. We're reducing the percentage commission in our outlets release. I'll probably touch on it later, but that's actually coming down. But so that's what the difference is. The difference is that node operators pay the commission and the RE kind of liquid stakers essentially pay that commission to the node operators out of
Like,
the rewards that get generated.
like a service fee for running the node.
That's right. Yeah.
Okay. And the talk of the town right now, of course, is the Ethereum Shanghai upgrade. And for our audience, maybe a brief recap here. Set for April 12th, the Ethereum Shanghai upgrade will allow the unstaking of ETH that has been staked on the beacon chain since December 1st, 2020, and especially since Ethereum moved to proof of stake with a merge on September 15, 2022. By that, the biggest proof of stake chain, second largest to Bitcoin, will allow potentially unstaking of 33.8 billion US dollars worth in stake market cap, according to latest data on staking rewards. And the possible effects of this on the ETH price have been widely discussed in the industry. And also at Staking Rewards, we had our institutional ETH staking post Shanghai online forum, where you, Darren, also were part of the panel, of the liquid staking panel. So what would you say? What should be the likely effect of the Shanghai upgrade on the Ethereum price?
So obviously, there is going to be quite a lot of ETH coming back. From all accounts, from what we're kind of seeing, there'll be this ETH coming back initially, but so from the kind of the surveys and that sort of thing we've had, some people will sell some but for tax. I think a lot of people are actually restaking or thinking about restaking their ETH and this sort of thing. So there's certainly that. There's not that many people that say they're going to like fully withdraw. There is this kind of talk of like a great reshuffling, which is essentially withdrawing and then depositing again with another provider. So that there is kind of that, talk of that sort of thing as well. So you may get some of that movement. In terms of the ETH price, that's very, very difficult to kind of tell. I think in the short term, it might budget slightly. We're actually expecting like a massive kind of inflow into staking, which I would see would probably offset most of that kind of, that price movement there. So I think that it's very, very difficult to tell, but I would kind of, we're expecting like a massive uptick in the amount of kind of stake going into the system. So that's going to be very interesting to kind of watch. There's a lot of players that are, so I'm surprised there is 16 million or 17 million being staked at the moment. That's 16 million of crazy people money, because there hasn't been until like, a few weeks ago, there wasn't a date for when withdrawals were implemented. I count myself in that crazy money, by the way, but there wasn't a date for the withdrawal. Now, liquid staking has played a bit of a part of that, because that was the other benefit of liquid staking, is the fact that it allows you to withdraw by swapping it on the open market as well, which currently, Ethereum at the moment, as a normal node staker, you can't withdraw until this Shanghai hard fork. And so you haven't been able to do that. And so people who don't like the idea of a one way ticket, are definitely looking at liquid staking, also staking in general, and thinking, well, now that I can withdraw at any point, I'm not locked in for a non-determinate amount of time, then now this is kind of something that I'm happy kind of doing. There's also other, as we said with the institutional thing, there's a lot of people who, for compliance reasons, organizational reasons, just can't do that. They can't put their money into something that they cannot withdraw from. And so that makes perfect sense as well. So once that's kind of happened, those reasons are gone. And so there's a very high chance that there'll be a very up. We saw a very big uptick in post-merge. Post-merge, our kind of TVL just really, really ramped up, because the execution risk of the merge had gone away. And the same sort of thing will happen with Shanghai. The execution risk is gone. The excuses are gone. Really, now there's no excuse really. So so that we will see that kind of going.
Yeah, one of the biggest benchmarks is you can use a staking ratio, and a staking ratio for all other major proof of stake blockchains are 40% plus. And due to this, up until now, liquidity risk for simply staking your ETH and not being able to unlock or withdraw it kept the staking ratio for Ethereum at about 14 to 50. And it is a reasonable assumption to say that after the Shanghai hard fork, with all the institutions now being able to invest, and also liquidity risks haven't gone down for retail investors, that this will also increase to, let's say, 40% in some amount of time. Of course, it won't go directly, but still. So from that staking behavior, this, if all, should have a zero or positive effect on the price. And then the other thing that you mentioned, of course, is also it will be more the independent validator node operators that will unstake and then potentially even restake, in the sense of rotating into liquid staking protocols as well. So if any, this is super bullish for all the liquid staking providers for ETH, including Rocket Pool. And this now plays into an interesting thing, because it looks a little bit like a perfect storm for liquid staking right now. And Lido went ahead and said that they would actually defer unstaking for some time after April 12th, just to make extra sure that, everything works out fine and they can execute with a minimum risk. How is the situation with Rocket Pool? Are you confident that you will allow unstaking relatively soon after April 12th, or do you also have some deferral time?
Yeah, so we'd be very close. So we have kind of like a technical critical path where we can't before Shanghai, and we actually have to wait for a particular point within our protocol's lifecycle for us to kind of do it. So we'll be probably a day or two after, but we want to be as close to kind of Shanghai as possible, so that our node operators can start receiving their skimmed rewards. Because that'll be the first thing, will be those skimmed rewards, which would be anything above 32 ETH. So that's something that we're kind of targeting. So we're targeting I think it's like a day, maybe it's a day and a half to 2 days afterwards. So that's our kind of launch target. And that we're confident at this point. We've gone through one testnet and kind of improved based on that. We've just the last couple of days deployed to our actual main testnet. And so our community are now going through and doing community testing of Atlas to make sure that Atlas is our release that takes into consideration withdrawals. And so our community are going through and testing that, and that seems to be going very well. So that's good. So we'll do some final testing and tweaks and refinements, and then we'll be able to actually kind of release, very, very, very soon after.
Do you anticipate some competitive dynamics coming from that, being able to move faster than Lido at this stage?
I'm not sure. It all kind of comes out in the wash. I think I don't know. I'll let the market decide that.
Yeah, because from an ecosystem perspective, we have the problem that crypto tends to be power law distributed. So you have the first mover or the biggest player taking up 50% or even more of market share, and then it drops off steeply. And in terms of decentralization, we would wish that actually for liquid staking providers, we have some more equal distribution between Lido, Coinbase, Rocket Pool, Frax, Anchor, maybe. So it would actually be a good thing if in this way, Lido being the big tanker, so to say, that cannot move so quickly, it loses some market share to the smaller providers like Rocket Pool, who are able to move faster in a more nimble way. And it would be even beneficial for the overall ecosystem.
Yeah, there's quite a few polls that are they're at different stages of kind of release or development that are kind of coming through. And so we will see more competition within the market, which I think is great. As Rocket Pool, we think the whole staking market is a rising tide. And so everyone's going to kind of benefit from that rising tide. We do think that, Lido has gotten, and the community at large think that they are probably too big. As we said, that they threaten the integrity of Ethereum if they get any bigger. So there is kind of that as well. And I think the market has realized that. The community have been very loud about that, rightly so. And I think the market have definitely switching on to that, because really is a risk management thing that you need to take into consideration. If Lido gets too big, then it undermines Ethereum because they essentially become just the way that proof of stake works. So that is definitely a thing. So we do need more competitors. We've already said that if we get, it's easy for us to say we're at like 2.8% or something. We have said that we would limit if we got kind of too large, because we would rather limit our growth than undermine Ethereum. So that's kind of our kind of philosophy on it. So yeah, but there are many more competitors coming to market. So we will see those coming.
And one other competitor, in a way, like not direct, but indirect competitor, Kraken, had the settlement with the SEC on their staking program and staking services, settled for $30 million. Settlement, I think, it's not a way that there was a legal case being made that can be referenced to, which is, all of the legal fine detail there. That's interesting for anyone who's interested in regulation about staking. There I can recommend Proof of Stake Alliance and Alison Mangero, who gives a great overview there and also is a bit of the voice for the industry for staking regulation. But what interests me on your case, Darren, now is whether you saw an uptick in staked ETH that was being sent towards Rocket Pool coming from this SEC crackdown.
It's difficult to tell, because we're kind of a permissionless protocol. So we don't track where people come from, unfortunately. It would be great for an analytics and product decisions, but no. So we're permissionless protocols. We don't have much of an idea behind that. We have seen a bit of an uptick kind of across the board. So I think there's definitely some movement there, but it's just difficult to pinpoint whether that's just increased demand in liquid staking in general, or whether it is a kind of based on the Kraken decision.
Mm-hmm. And last question, what are your plans for the Rocket Pool token RPL? What is its role, functions, and any updates that are relevant for the RPL token moving forward?
Yeah. So RPL plays a couple of different roles. So first of all, RPL is a backstop collateral. So actually one of the things we're releasing with Atlas is reducing. So at the moment we need 16 ETH from a node operator, 16 ETH from the liquid stakers. In Atlas, we're actually reducing it to 8. So we're going to need 8 ETH from a node operator and 16 from a 24 from a liquid staker. So we're actually technically we'll 3x our capacity in that sense. So that's going to be great for It means that we'll be able to scale a lot faster with that. One of the slight changes is that, so RPL, in reference to that as well, RPL is a kind of a backstop collateral. So if anything goes wrong, generally it's the ETH that gets, of a node operator that gets it first. And in the most dire situations, and when I say dire situations, I mean like Ethereum hasn't finalized for 2, which is kind of a very, very black swan event. If Ethereum hasn't finalized in an hour, people are jumping up and down. So in those situations, Ethereum is in deep trouble. You can burn through that collateral. And so even 16 ETH. And so RPO actually provides a backstop collateral for that. With 16 ETH, you need 1.6 ETH worth of RPL to actually stake with Rocket Pool. So you stake your ETH, your 16 ETH, and 1.6, a minimum of 1.6 ETH worth of RPL. In Atlas, you need 8 ETH, but you need 2.4 of the RPL, 2.4 ETH of the RPL. And so what that does is if we've run out of, then we use the RPL as collateral to make sure that our ETH holders are whole. With that kind of 8 ETH and the 2.4 ETH of RPL, we're supremely comfortable that we've covered all the major scenarios that Ethereum, or most of the major scenarios that Ethereum can go through, even a lot of those kind of black swan events. So that's one thing it's used for, is this backstop collateral. The other thing it is for governance. So unlike a lot of other governance tokens, RPL itself is not a governance token, but when you stake it within Rocket Pool, it is a governance token. So if you stake it, if you're a node operator and you're staking RPL and essentially providing value to the protocol, then that is your voting weight. So the amount of RPL that you're staking within the protocol that's being used within mini pools, within validators, is your voting weight. So that's kind of like the governance. Also, for staking that RPL, it's also kind of like an incentivization mechanism as well. Also, for staking the RPL, you also get RPL inflation. So RPL inflates by 5% per year, and 70% of that goes back to node operators as like a reward for, well, first of all, to attract node operators, but also a reward for staking the RPL within the protocol. And so they get 70% of that goes back to node operators as a reward for doing that. So that is the kind of roles of RPL. As I said, with Atlas, it changes slightly in the sense that, well, you're taking more ETH from liquid stakers, so from 16 to 24. And so you actually provide more RPL in that case. And so that's kind of the main difference in the future for RPL, is kind of that change in mechanism.
And if RPL serves as backstop collateral, where does the value from RPL itself come from? If I think about it like that way, people would need to sell it to cover losses, so to say. So I have value for that.
That's right. Yes. So RPL has been around for a long time. It's had a value for a long time, since, as you said, 2018. I think it was actually at the end of 2017, the ICO. The value comes from the fact that people who want to, okay, so as a solo staker, you need 32 ETH. Okay. But in Rocket Pool, obviously you need 8 ETH plus the 2.4 ETH of RPL. So we've kind of lowered that barrier of entry, and to lower that barrier of entry and to kind of do that, you have to stake RPL within the protocol itself to kind of do that for the reasons that I've said, the collateral backstop and the kind of governance and aspects of it as well. So and currently there's around, I think it's about 30% of RPL is actually staked within the protocol. And so that access to be able to lower the barrier of entry for staking, to be able to earn commission on the rewards that you're staking on behalf of the pool, all of those things kind of, plus also you get RPL rewards as well. All of those things kind of combine to the reason why people would want to have RPL, and particularly so RPL outside the protocol has a value, but it's most of its value is if you use it within the protocol. And so there are a lot of people that are splitting up mini pools. With this change from 16 to 8, there'll be a lot more people with 8 ETH than there are with 16. And so we kind of expect, a lot more people to be able to now be able to run validators and be able to secure Ethereum and be a part of proof of stake. And so the more people that do that, the more people have to access RPL and use the product.
Got it. All right, closing it off here. What's the best way to follow you and Rocket Pool?
Yeah. So Rocket Pool is on Twitter. Yeah, Rocket_Pool. I am Langer's on Twitter. So yeah, they're probably the key thing. Actually, hit up our website. The best introduction to Rocket Pool that you can ever get is to join our Discord. I kid you not, it is a thriving metropolis of goings on. So go in there, go into general, ask some questions. If you dare go into trading, which is kind of like the heart and soul of Rocket Pool, there's not a lot of trading talk in there. Well, there is trading talk in there, but it's a mixed bag of things that go in there as well. But yeah, so there's a lot going on in the Rocket Pool Discord. There's everything about our governance. We're hyper transparent. So there's all sorts of stuff going on.
Thank you, Darren, for being so generous with your time. We have been speaking with Darren Langley, General Manager at Rocket Pool. If you enjoyed this conversation, subscribe to our YouTube channel for more episodes from the forefront of staking. Follow me on Twitter, that's at Marian_Walter_ and our team at Staking Rewards. You've been listening to The Staking Insider. For Darren and the audience, thanks for tuning in.